Today, we're going to do a deep dive in one of my favorite financial strategies, infinite banking. We're going to talk about what it is, how it works, why it's so freaking popular, and who it is and who it is not for. My name is Arman Vakili, your value plug, and if you want to get more cool videos like this, or if you want to learn strategies for defunding the IRS and all that cool stuff, go ahead and subscribe or follow, and definitely make sure that you turn on the notifications so that you get notified the next time that we drop something. All right, some housekeeping rules. Even though the strategies that I'm about to share with you and all the accounts and everything that I'm going to show you today are available in every single one of the states in America and even in other countries as well, I want you to consult with your local tax advisor because your jurisdiction, your state may have some nuances that may be different. Your business may be set up in some special way that you got to take care of and you got to make sure that you attend to it. So just make sure that you consult with your tax advisor so that everything is all good and we don't have to worry about any of it. That being said, the first question that we got to answer is, what is infinite banking? If we were to sum it up in a single sentence, infinite banking is a financial strategy that combines several money hacks to create an infinite flow of income. To explain it a little bit deeper, let's go into the presentation. So here's our beautiful infinity symbol. It is, after all, infinite banking. And in this infinite cycle, everything is going to start with and end with income. And so the big important thing is we're generating our income from a business. Now, this is very important. We're going to talk about this later. But you've generated your income. And one of the big things that you want to purchase with that income would be either a UL, VUL, or an IUL. And we're going to talk about what all of those things mean and what all that stands for. But once you purchase this, the income, the money that's been placed in those plans is going to start growing and it's going to start accumulating interest. Now, depending on how it's set up, all of that we'll talk about later. But once it has grown, there are certain stipulations that you can meet to get a 0% loan against that money. And of course, 0% loans, being that you don't have to pay any kind of interest on it, you don't have to pay it back. So what we would do in this situation, we would use that loan to buy an investment, and you would purchase an income generating investment specifically because you want to restart this infinite cycle. You want to feed the cycle one more time and then start again with income and then go ahead and extrapolate this and keep doing this over and over and over again until you've gotten to a certain point that your income is so abundant and your passive income is surpassing all of your expenses and anything that you could possibly desire, which at that point we would call financial freedom, right? So the whole idea is you repeat this infinite cycle until your income gets to the point that it will pay for your dream lifestyle, right? So let's talk about what all of these actually mean and what the nuances are in every single one of these steps. All right, so everything begins and ends with income. And in this particular situation, we just need to make sure that it is business income. So it could be an LLC, a corporation, doesn't really matter. You could be a solopreneur, you could be the executive of a large corporation, does not really matter as long as the income is coming through a business. Now, the reason why this is important is because having your income come through a business allows you to have a lot of different types of write-offs. You can defer a lot of things at the end of the year. And this particular plan that we're going to leverage is going to become an expense. So this next purchase that you're going to make will be an expense to the business. And I'll explain why that works and how that works. But it is going to be an expense to the business. So therefore, the business gets to write it off as a cost and not pay taxes on it at the end of the year. Now, the purchase is going to be a UL, VUL, or an IUL, which is either a universal life, variable universal life, or an index universal life. Now, what that means specifically is twofold. One, you got to understand that it's a life insurance policy. This is very, very important, and there's costs to it and all those things, which is what people sometimes maybe don't consider, or maybe the brokers don't disclose this enough, or they shy around it, whatever that may be. So it's a life policy, so you just got to keep that in mind. But then the UL and the VUL and then the IUL, that's how the interest is credited to these accounts. So let's look at it for a second. All right, so what you're seeing in front of you are three different lines. The blue line is going to represent a fixed return account, and that would be the UL in this situation. A UL gets a fixed rate of return. 2%, 3%, 4%, 5%, doesn't really matter. It's through different carriers and different carriers offer different rates. But what you do need to understand is that it's a fixed rate account, okay? So that's the first thing that we got to understand is that the UL is the blue line and it's a fixed return. The VUL, the variable universal life, is a variable account. So what you see in the red line is what we can expect the variable universal life to look like. And that red line represents the S&P 500's actual performance between those years. So if you had a variable universal life, then your cash value would vary according to the performance of the market. Now, this in a bull market isn't a bad situation because people can be making money in the bull market and nobody really cares that much that there's a cost of insurance being taken out of this thing. On top of that, you got to consider that there's also asset management fees that are being applied to it because it's a variable account. So there's an account manager sitting there that's managing these funds, that the money that's inside this account. So on top of the insurance cost, there's also the asset management cost. Now, what happens in a bear market is that those costs become really, really, really harsh, or at least they seem really harsh because it's a bear market. The account is losing value. So if your cash value is already depleting, the last thing that you want to see is there's insurance costs coming out of it and there's asset management costs coming out of it, which is why these plans specifically, they were doing really well when the bull markets were around. And at that time, a lot of people pushed them because brokers were making a killing promoting these products. And so they just went with it, and all of a sudden the market crash happened in 2008, which was the really big one that affected a lot of people. And everybody said, you know what, that's trash value life insurance. We don't even want to talk about that. You're going to lose money, all this different kind of stuff. So nobody wanted to talk about it anymore. But then the beauty of this industry is the next line, which is the green line, which is the index universal life policy. And as you see, the index allows you to participate in the returns of the market. So the first couple of years, we see that there is a return in the market and we get to participate in those returns. But you notice that there's a spread. There's a bit of a difference between the peak of the red line and the peak of the green line those first couple of years. And that difference is what Fidelity Guarantee would keep, or AIG would keep, or National Life Group, or Anico. Doesn't really matter, right? The insurance company keeps that spread because they're in it to make money as well. Now, what happens is that they offer you the protection on the crash. So when there is a crash, and there is going to be inevitably a crash, at the time of this recording, we're actually in a pretty steep bear market. So whenever there is a crash, you get that 0% protection that the money will never go below 0%. Your cash value, whatever you earned, will never go below 0%. And instead of picking up from the bottom, you pick up from where you left off. And again, the growth is not as aggressive as the red line, but when another crash happens, you get protected against that crash. And when we look at this in a long-term period, a 10-year, 15, 20-year period, the index will always outperform the variable markets. Now, the issue with these is about funding. And this is where a lot of people have issues with cash value insurance because, and then we'll talk about specifically what that actually means. But before I get into funding, I just want to tell you about the next piece of it. So now we understand how these things grow. We understand how cash is accumulated in these various types of accounts. The way that you're going to purchase these to make it an expense to the business so that the contribution to this becomes a write-off to the business and the money inside these accounts will grow tax deferred for you. The way that you do that is you do it through an executive bonus plan or a qualified pension. Now, executive bonus plan is just like it sounds. You give a bonus to the executive. So if you're the sole proprietor of the business, it's just you, then you're considered an executive, right? You're the main key executive. You're probably the manual labor too, and you're the workforce, all that, right? But you're also the executive. So what you do is you pay yourself a bonus as an executive, and then you have to use that bonus to purchase one of these plans in order for the tax write-offs and everything else for this infinite banking strategy to work. So what you're going to do is either pay yourself a bonus as an executive or you're going to purchase a qualified pension, and the qualified part touches and relates to the tax deferral of these accounts. And so you can do either of those two, and whatever goes into it will end up being deferred. Now, what's really fun about this is that unlike SEP IRAs or any other of these qualified plans that a business can contribute to for a write-off, there are no contribution limits to these plans. You could put as much money in it as you want to as long as you adjust the benefit amount, and we'll talk about that in a little bit. The second part about it is that you don't have to offer it to every single one of your employees. A SEP IRA, if you offer it to one employee or one executive, you have to offer it to every single person that's been with you for at least 3 years and work with you full time. And unlike those plans, or unlike a 401k that everybody has to participate in, this is a plan that you can select key employees or key executives for, and then you can do this for them, right? So this is a really cool part about this plan. And of course, there's no contribution limits. Now let's talk about funding, because I think this is the part where everybody that has had a bad taste in their mouth has dealt with this situation. And unfortunately, it's on the broker, it's on the agent that presented the product. It has nothing to do with the client. So let's talk about that a little bit. Funding brings with it two different thresholds and two things for us to keep in mind. The first threshold is the cost of the insurance policy itself. So as we've established, these accounts, these VULs, ULs, IULs, are insurance policies. They're cash value insurance policies. And so there's a cost associated with them. And that's going to be our first threshold. The second threshold is going to be our maximum funding threshold. Now, why is there a maximum funding threshold? Because the IRS understands that there's tax advantages that comes with these accounts, so they don't want to give you an unlimited amount of money that you can dump in here. You can increase the maximum funding threshold by increasing the cost of the insurance policy. So we can incrementally add more value to the insurance policy itself, the face amount of the policy. And by doing that, the maximum funding threshold will increase. So if you wanted to contribute $10,000 a year, you would get a certain level of insurance. If you wanted to contribute $100,000 a year, then you would increase that insurance so that it gives you that much more funding threshold. Now, in any situation, the maximum funding threshold should be the client's budget. And the cost of the insurance should be the lowest amount of policy that the carrier, whatever the carrier is, allows you to purchase. So we call this the minimum death benefit maximum cash value approach to creating an illustration. And it's literally a button in a lot of cases that you can just press, and you press that button and you say, I want to adjust all my calculations to meet this minimum death benefit maximum cash value formula. And then at that point, you would put in the client's budget, and let's say it's $10,000 a year. And so the software will adjust automatically, and it will decrease the face amount, the insurance itself, to the lowest it can possibly go. So the bulk of that insurance contribution, the bulk of that $10,000 is going to go to the cash value. And this is how you set up the funding of these accounts so that you get the maximum cash value accumulation possible. And obviously the cost of the insurance would be minuscule. It would be super low so that it makes sense for somebody to leverage this as a wealth accumulation product, right? But this isn't usually what it looks like for most brokers when they design these cases for their clients, because as a broker, we can make a significant amount of money selling these products. But if you're not in it for the client's best interest, then you're going to make some difficult decisions, some ethically questionable decisions. And so here's what that looks like. And here's what it looks like in most cases when we're talking about funding these accounts. And then once you see this, you'll understand why so many people have such a big disregard for it and they just don't like these things. So here's what it looks like in a bad way if you don't properly fund these things, or if the broker is greedy, or if the agent is greedy. In this particular example, the cost of the insurance would look like this, because the agent wanted to make a lot of money. And the maximum funding threshold would probably be the same because the client's budget didn't change. So the only thing that changes in this situation is the cash value accumulated in this account. Now, if the person came and promoted this particular plan as an insurance policy and they said, hey, this is a permanent insurance policy, you're going to have this for the rest of your life, and there might be some cash value in it, that would be an okay presentation of this. But if you presented this as an accumulation product and you said that you're going to grow your money this way and this is infinite banking and all these different kind of things, but you set it up so that the client doesn't make any money, then that would be a misrepresentation, and it's ethically and morally just really wrong, because the whole idea is for you to generate cash value. So in this particular example, the cost of the insurance is so high that it eats away from the cash value. And then if we go ahead and go look at the variable example again. So if this was a variable universal life policy, the cost of the insurance is so high that the cash value is barely accumulating anything. And if it's a bear market, like the market that we're in right now, the cost of the insurance would eat away at the cash value so quickly because the market itself is losing money. And then factor in the fact that there's asset management fees that come with any variable account. Doesn't matter if it's a VUL or a 401k or an IRA or a mutual fund. There's asset management fees that come with variable accounts. So you have your asset management fees, you have the cost of the insurance, and then you have the downward turn of the market. And then, of course, obviously the broker was so shady that they set this thing up to to feed their pockets so much that there was literally no chance for this policy to survive. So this is why people call it trash value insurance, or they have any kind of beef with it. And truthfully, this brings us to one of the biggest asterisks of this whole thing. If you're in a health situation where your cost of insurance would just be too high, it doesn't make sense for you to do something like this because your health is bad and your cost of insurance would just be way too high. Okay, so let's say that you contacted me directly and I took care of you and you don't have a high cost of insurance and your plan was set up so well that you've accumulated a great amount of cash value inside it, and now you want to access that money. And this is the part where it starts getting really, really fun, okay? So one of the inherent features that comes with a VUL, IUL, or a UL is that the company that offered it to you, so let's say we use National Life Group. If National Life Group offers this to you, they offer something called a power option loan or a loan option. They have different names for it. These loans can come at a 0% cost. However, there is a catch. You got to wait a certain amount of time. So what does that mean? It means if you wanted to access the loan option in your cash value, in 95% of cases, most carriers are like this. If you wanted to access your cash value prior to year 10, so anytime sooner than year 10, you would most likely pay a 1% to 2% fee or interest rate on that loan. If you wanted to access the cash value, or if you could wait to access the cash value 10 years or more, then you would get a 0% loan. In most cases, a lot of people don't wait the 10 years because the 1% fee or the 2% fee, the interest rate, isn't so high for them to stop this process and go into the next step. Because the idea is that you use this loan to purchase more income, right? So if you wait 10 years, great, you get a 0% loan, you get to purchase that income at 0%. If you don't wait 10 years, you get to purchase the income at 1 or 2%, which is still a steal. Our final step, which is you buy an income investment only. Now, this could be an annuity because annuities have an inherent income rider attached to them that they give you a fixed income starting month one, and then you can just live off of that income, or you just reuse that income to buy more of these policies and further create your infinite bank. Or you buy real estate properties, and then the real estate property again would just go back to the beginning of the cycle, and each property is an LLC, or it acts as its own entity. So you can use the funds from that to go ahead and purchase another executive bonus plan, so on and so forth. So this is what it would look like as far as just the details of the breakdown of these things are concerned. And we come back to our main page. So this is where we started. And just to review, we have the infinite banking, and where it all starts is income. And income is used to purchase a UL, VUL, or an IUL, depending on which one your preferred strategy would be. The money grows inside those plans, and whenever you're ready or whenever the plan allows you to, you take a 0% loan against that, and you borrow that money to purchase an income investment, which will generate more income for you, which will feed back into this cycle. And then you just repeat this cycle until you've gotten to the income level that you want and your ideal lifestyle requires. And at that point, you're financially free. Okay, now that you know what infinite banking is and how it works, the next question you got to answer is this going to be something that you're going to leverage? Now, obviously, I can't answer that for you. I'm pretty sure there are a lot of questions that you got that I can answer for you, though. So to make sure that you have all the information and to see if it's something that you can leverage, go ahead and send me an email. You can DM me, and either myself or somebody from my team will contact you. We have licensed consultants across all of America, including Puerto Rico. We represent the top carriers in America. We charge zero consulting fees, zero broker fees, none of that stuff. And if we do business, great. If not, no hard feelings. But at the very least, I figured it would be a good idea for you to get all the questions that you got answered. Maybe we can even play around with some numbers and see what the proposals and the illustrations look like specifically for you with your numbers. And then you can see if it makes sense. And if it does, again, sweet. If not, no hard feelings. I hope you at least got value from this video. And if you have any questions, drop it in the comments. Shoot me an email. We went through all that stuff. My name is Arman Vakili. I hope you're having a beautiful day wherever you are. And I'll talk to you in the next video.